All right, the alternatives map by the alternative investor. I'm Brad Johnson. We're going to talk about correlation, returns, and income and how they're not the same thing in each of these asset classes. The bubble size is the amount of income per asset class. To the right here, it's more correlated to the 60-40 vanilla bond and stock portfolio. To the left here, it's less correlated, right? It moves differently than just a traditional 60-40 portfolio. Higher returns, lower returns. All right, that's the spectrum. All right, transportation, we're talking about infrastructure down here. You have lower return profile and a little bit more diversifying. On the top here, you have hedge funds, right? You have more correlations to a 60-40 portfolio, but higher return potential. Private equity, less correlation. This is alternative. Venture capital, same story. Really high return potential. Of course, more risk, more dispersion of outcomes. Direct lending, private credit, highly diversifying, a little bit lower return, but big income, right? There's a big bubble here. Real estate, similar story. Real estate generally is a little less risky than some of these other strategies over here, right? And timberland, cutting down trees, low returns because obviously not very exciting. We're always going to need wood. All right, so you get a sense how to read this. Left, right, more of diversification, up, more return potential, and bigger is more income. And you want to factor all this in when you're thinking through your portfolio and adding alternatives. You want to optimize for diversification, income, and of course, total return. All right, if this was interesting, go ahead and subscribe.